Hello, everybody. I hope you're doing well. Hope you're enjoying all the classes today. Welcome. Let's go ahead and read a legal disclaimer for your enjoyment. Today's demonstrations are designed to instruct you on using MetaStock and the different analysis techniques. These are not recommendations to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock and Options Masters Live should have no liability for any investment decisions based on the use of the software, trading strategies, or any information provided in connection with the companies. All right, John, it's all yours.
Jeff, thanks a lot. Really appreciate your help. Again, I will not miss an opportunity to thank MetaStock and Jeff and their great support for this event. MetaStock is a phenomenal product that offers a lot of capabilities and makes trading just so much easier. So hope everybody is checking out MetaStock and getting more information about that. Our next presenter, Chuck Hughes, is someone I think a lot of people are familiar with, but you can't understate his accomplishments as an Air Force pilot and as a multiple trading champion, trading competition champion. Chuck has just educated so many thousands of traders and really kind of brought option trading to the masses. His reach is really profound and he's touched so many folks. It's always a pleasure to have Chuck as involved in our events. So we're really honored to have him here. Chuck, thank you so much for being here. We're looking forward to your presentation.
Okay, great. Thank you, John, for the introduction. Good afternoon, everybody. This is Chuck Hughes. It's great to be here this afternoon. And I'd like to talk about the global paratrend system, weekly cash payout strategy. And this is a strategy that is approved in IRA accounts. It's a very low risk strategy. And I found that overall, it's a very good strategy for the average trader. And you can implement this strategy with about a $5,000 trading account. It doesn't take much time to implement the strategy. So it's one of the strategies that we trade week in and week out. And it's been a steady performer in all types of markets. So we're going to look at collecting weekly cash payouts, and we collect weekly cash payouts from trading weekly covered calls. And weekly options, as you probably know, expire every Friday, and weeklies give us 52 opportunities each year to collect cash payouts. And these weekly cash payouts can be put in your trading account without taking big risks, and they can give you a totally different perspective on income investing. The payouts are in cash. They're deposited directly into your brokerage account, and once the money hits your account, it's yours to keep, and you can spend the cash immediately or do anything you'd like with the cash. It takes about 20 minutes a week to implement the weekly cash payout strategy, and the cash payout trades can be traded in a regular brokerage account. We get to keep these cash payouts regardless of what happens to the price movements of the underlying stocks or ETFs. And unlike normal stock dividends that pay 3 or 4% return over the course of a year, we regularly collect up to a 1 to 2% or higher cash payout weekly. In our brokerage account transaction reports that I'll display at the end of the presentation shows that over the past 10 years, we collected $5.6 million in cash payouts. So that was cash that went into our brokerage accounts doing the weekly cash payout strategy. So that turns out to be about $47,000 in cash payments per month on average. So the brokerage confirmations I'll show you at the end show the option that we sold and the amount of cash that was credited to our account after commissions. And as I mentioned, this strategy is approved by the IRS for trading in IRA accounts. And we actually trade this cash payout strategy in our retirement accounts. You can start out small with this strategy. You need $3,000 to $5,000 to start collecting the weekly cash payouts. And the weekly cash payout strategy actually incurs less risk than owning stocks or ETFs, and I'll show you an example of that. The strategy works well in bear markets. We collect weekly cash payouts during bear markets and have done that over the last 3 bear markets. And we use inverse ETFs to collect the cash payout. And of course, the inverse ETFs profit when the stock market is going down. Now, the weekly cash payout strategy is a covered call strategy that generates cash payouts from selling call option premiums on the ETFs or stocks that you own in your account. This cash payout strategy can produce consistent returns during volatile and non-trending types of markets, which occur over the vast majority of time. So a lot of investors are not familiar with the concept of selling option premium to generate cash payouts. Selling option premiums is a very simple strategy, but it can be very lucrative. The cash payout strategy is also known as a buy right or covered call. And when you sell to open a call option, cash equal to the premium is immediately credited to your brokerage account. And of course, one option covers 100 shares of an ETF or stock. So if you sell the call option with a 2-point premium, you'll receive $200 in cash into your account. So that's 2 points, $2 times 100 shares is $200 will be credited to your brokerage account minus commission, which nowadays isn't much. I think it's 50 cents nowadays. For example, we own 1,000 shares of the small cap ETF symbol TNA, and we sell 10 call options weekly to generate income with that 1,000 shares of TNA that we keep on our account. So our brokerage transaction report shows that on August 26th, we sold 10 of the TNA September 2nd, which is a weekly call, the 75 strike call at 320. So if we multiply the 10 contracts times the 320 premium, that comes out to $3,200 in cash minus your commission. So you can see in green right here the cash that was credited to our account from selling the 10 contracts. Now the sale of those 10 75 strike calls was covered by the ownership of the 1,000 shares of TNA that we had in our account. And unlike a traditional stock dividend, you don't have to own the stock on the dividend date to receive the quarterly dividend, and you don't have to wait a year to receive a 3 or 4% annual dividend yield. You can receive up to 1 to 3% cash payout every week, selling at-the-money call options on stocks and ETFs that trade weekly options. Now, the cash payout strategy is easy to implement by purchasing 100 shares of an ETF or a stock and then selling a weekly call option, which can be done in a regular brokerage account. So easy to implement. You just buy 100 shares of the stock or ETF and sell to open one weekly call option. And let's look at a trade that we implemented recently. Our brokerage confirmation shows that we purchased 100 shares of the energy ETF symbol ERX on August 26th. And we paid $31 0.479 per share. So the cost to purchase 100 shares plus the commission was $3,155. So this is the first leg of the two legs of the spread. Bought 100 shares of ERX at $31.47, and at the same time we sold to open the energy ETF September 2nd 31 strike call at $1.10. So at the same time we bought the 100 shares, we sold to open the September 2nd 31 strike call. So this was done on August 26th. So the September 2nd call expired 7 days later, and we collected a 110 premium on the sale of the call option. So this call option expired 1 week later on September 2nd and is known as a weekly option. And we get to do this 52 times over the course of a year using weekly options. So when we sold the September 2nd 31 strike call at 110, $110 in cash was credited to our brokerage account minus the commission. So that came out to $101 after the commission, and cash was credited to our brokerage account. So there's two possible outcomes with this ERX 31 strike covered call at option expiration 1 week later. Option or outcome number one would be if the ERX ETF is trading above 31, which was the strike price of the call option that we sold, then the ETF will be called and 100 shares of ERX in your account will be sold at 31. Now this happens automatically at option expiration. Any in-the-money options will be exercised automatically at option expiration. So in this example, if we sold the 31 call and it closes above 31 at option expiration, the ERX shares will be called. Now, if the ETF is called, then we realize the full profit potential for the trade. So with the covered call, if the stock closes at or above the strike price of the call that you sold, then you realize the full profit potential for the trade. The second possible outcome is if the ERX is trading below 31, then your shares will not be called, and we get to keep the 100 shares in our account. So if ERX drops in price over that 1 week period, any loss would be reduced by the $101 in cash payouts that we received. So if the ERX drops a point over that 1 week period, then we would just about break even on that trade. So any drop in the price is offset by the call option that we sold. And then of course, if it did drop in price, at expiration, you could sell another weekly call that would be good for another 7 days and collect another premium. So we like to keep the shares of the ETF in our account so that we can collect that cash payout every week. So we do this by rolling over the expiring call option at expiration to prevent being called. And in this example, we sold short the September 2nd 31 strike call. So that's going to expire on September 2nd. So September 2nd was a Friday. So that Friday we would close out this September 2nd 31 strike call, and then we would sell to open another weekly call at the money call on September 9th. So you can see on September 2nd, the September 2nd call expired. We closed that out, and then we sold to open the September 9th 30 strike call. So we roll these over each week and that way we get to keep the ETF shares in our account. So on September 2nd, we sold the September 9th weekly call at $156 that was credited to our brokerage account. So then we repeat that cycle on September 9th. We would close out the expiring option and then sell to open the weekly September 16th option, which expires 7 days later. So we sold the September 16th 32 call and we received $126 in cash when we rolled that option over. So again, this allows us to collect these weekly cash payouts every week for 52 weeks over the course of a year. Now, if you forget to roll over on Friday and the ETF shares are called, it's not a big deal. You can simply buy 100 shares of the ETF and sell a weekly call option to reestablish your covered call. So if you forget about it and the stock is called, it's not a big deal. You can just buy 100 shares and then sell another weekly call to get reestablished. So we continue to roll these weekly calls over several months. So we rolled into the September 9th 30 strike call, then September 16th, September 23rd, September 30th, October 7th. So each of these weeks on Friday, we would close out the expiring option and sell to open the 1 week option that would expire 7 days later. So we continued to roll this position over. We kept the shares of ERX in our account. So over this 10-week period that I looked at, we collected $1,264 in cash payouts after commission. So that averages out to about $126 per week in cash payouts. And if we collected the similar payout each week, over the course of the year, we have the potential to collect $6,552 in cash payouts. So this represents a 207% cash payout on our initial investment of $3,156 to purchase the 100 shares of ERX. So initial investment of $3,156, and we have the potential to collect $6,500 in cash payouts, which is more than 200% of our original investment. So if you collect a 207% cash payout, a lot can go wrong and you'll still be a successful trader. The stocks or ETFs could decline sharply and you could still profit. You could have bad timing on when you enter the trade and you can still profit. And it's possible to profit if the stock or ETF goes up, down, or is flat. So if you're trading these weekly calls and all of a sudden there's a market correction, you're going to close out that weekly call each week, and then you have another opportunity to sell another premium. So you just keep selling that premium through up markets and down markets, and you can collect a pretty good cash on cash return over the course of the year. So with this strategy, you can profit despite volatile price moves in the stock market, and you can also reinvest those cash payouts every week, and then you can trade more covered calls with the reinvestment of your cash payouts. And we do that regularly, where we'll get enough cash payouts that we can trade more contracts. So let's talk about the trade management of this strategy. Now, when we come up on option expiration, we use what is known as an option spread order to roll over those weekly calls. In option spread orders, it's one order, but the one order will close out the expiring option and you sell to open the new option, which allows you to keep the shares of the stock or the ETF in your brokerage account. So it's one order and you accomplish the closeout of the expiring and you sell to open the new 7-day weekly call. So here's an example of a rollover we did. This is an option spread order. This is for EEM, the emerging market ETF, and we own 500 shares in our account, and we roll over each week with 5 contracts. So this brokerage account order record here shows that we bought the close 5 of the EEM February 24th calls. So February 24th was a weekly call. And then we sold to open 5 of the March 2nd calls, 44 calls. So with this one order, we closed out the expiring February 24th, 44 strike call, and we sold to open 5 of the March 2nd, 44 strike calls. So by using the spread orders, we can reduce our commission costs and the option bid-ask spread transaction costs. So every time you trade an option, there's a bid-ask spread on that option. So you have to pay a little bit in transaction costs for that bid-ask spread. And of course, when we roll over, it allows us to keep the shares in our account. So now here's an example. This is for small cap ETF, symbol TNA. We had 800 shares in our account. So we closed out the expiring November 23rd, 52 strike call, and then we sold to open the November 30th, 54.5 strike call. So this, the November 30th was the new weekly call, and the bid and ask price on this spread, this rollover, was 75 bid, 95 ask. So what we do to save on the bid ask spread is we put the order in at a net debit of 85 cents. So 85 cents is between the bid and ask price. You know, if you were selling the position, you get the 75 cent bid price. If you were buying it, you'd get the 95 price to buy it. But we put the order in at the midpoint at 85. So that enables you to save a little bit on that transaction cost. So you can see we sold short the November 30th weekly calls at 142, and that was about, we were filling about halfway between the bid price of 140 and the ask price of 145 of the November 30th auction. So that saved us a little bit on the bid ask price. So we sold the November 30th calls at 142, so $1,125 was credited to our account for that weekly auction. So these are just examples of weeks where we took snapshots of the options we sold and the amount we had collected for that week. This week we collected 17,000. This week we collected 16,000, 10,000 this week, 19,000 this week. So these are just examples of weeks that we picked out and the amount of option premium we sold that week. And over that 10-year period, we averaged about $47,000 a month with cash payouts on these option premiums. So as I mentioned, the covered call strategy incurs less risk than owning stocks or ETFs. So let's look at an example of a covered call trade that can be profitable even if the underlying stock declines in price. And this brokerage account report shows that we bought 1,000 shares of Mosaic at 42.05, and we bought 500 shares of Mosaic at 41.90. So the average price for 1,500 shares was $42, and we sold to open 15 of the Mosaic 40 strike call options at $7.90. So we sold 10 of the options at 8 points, sold 5 at $7.70. So that averages out to buying the 1,500 shares at 42, selling to open 15 of the 40 strike calls at $7.90. And for this particular covered call, we received $11,850 in a cash payout because we had 15 contracts. Average price was $790 or $790. So we collected the $18,850, and of course that provides downside protection if Mosaic stock declines in price. So this is an example of a covered call where we lost money on the stock, but made money on the covered call because of the short option. So we took a snapshot of this covered call on our portfolio, and you can see for the 1,500 shares in Mosaic, we had a $1,600 loss, but we had, for the sale of the 40 strike option, we had a profit of $5,187. So we had a loss on the stock of $1,633, but had a profit on the short calls of $51.87. So when we took this snapshot, instead of showing a loss for the stock, we had a $3,500 profit for the covered call. So that just demonstrates the downside protection that the sale of that call option provides in a call option covered call trade. Now this trade was taken, this was a monthly option that we sold, but I just want to demonstrate the downside protection you gain from selling the call options. So now let's talk about trade selection for weekly covered calls. And we use 3 criteria for selecting ETFs for cash payouts. Criteria number 1, of course, is that the stock or the ETF trades weekly options. And criteria number 2 is we like the stock or the ETF's option premium to give us at least a 1 to 2% weekly cash payout when you're selling the at-the-money call. So we want to see a 1 to 2% cash payout each week, which can really add up over the course of 52 weeks. And then the third criteria is we want to see the price of the stock or the ETF trending up. So of course, with the weekly rollovers, we're going to collect 52 cash payouts, and the weekly options expire every Friday. So we're going to use weekly options to implement this strategy. And if you want a current list of all the stocks and ETFs that trade weekly options, you just go to the cboe.com website and look under available weeklies, and it'll list all the stocks and ETFs that trade weekly options. There's quite a variety now of stocks and ETFs that trade weekly options. So if you go to the CBOE website, you can get a listing of that. So with monthly options, of course, you collect 12 cash payouts a year. And monthly option expiration is normally the 3rd Friday of the month. So even though you collect fewer premiums with monthly options, we do also trade monthly covered calls on some stocks and ETFs that don't trade weekly calls. So if we see a stock or an ETF that's a really good opportunity and it doesn't trade weekly calls, and then we'll trade monthly calls. So we trade both the monthly and the weekly calls. And criteria number 2 is that the ETF or stock option premium gives you at least a 1 to 2% weekly cash payout. So our goal with weekly covered calls is to collect that at least 1 or 2% per week from selling the at-the-money call option. And the at-the-money call option has a strike price closest to the current price of the stock or the ETF. So, for example, the energy ETF symbol ERX, it was trading at $39.91, and on Friday, December 30th, the at-the-money weekly call, which was the 40 strike, because that was the closest to the price of the ETF, that 40 strike call could be sold if you purchase 100 shares at $39.91 and sell the 40 strike call the January 6th, then that would create a weekly covered call. So on December 30th, you could buy 100 shares at ERX, sell to open the January 6th call option, the at-the-money call, and that would be a 1-week trade. So at the time, the January 6th 40 strike call was trading at 110. So selling that 40 strike call, of course, would generate $110 in cash payouts minus the commission. And the way we calculate the weekly return is we simply divide the premium, the weekly premium, in this example is 110, by the cost of ETF of $31.91. So in this example, that January 6th 40 strike call trading at 110, if you divide the cost of the ETF, you come up with a weekly payout of 2.75%. So that meets our second criteria. We'd like to see at least 1 or 2% a week. And the way you calculate that is divide the premium, the at-the-money call premium, by the cost of the stock or ETF. And that tells you what the weekly payout is. In this example, it was 2.75%, so that would meet our criteria. Generally, with these leveraged ETFs, you can get 2 to 3 or even 4% premium each week for the at-the-money call. So they're, the leveraged ETFs are very lucrative as far as the option premium that you collect each week. Now, on January 6th, that 40 strike call, of course, could be rolled over by closing out that 40 strike call and selling to open the January 13 at-the-money strike call to collect another weekly cash payout. So to roll over, again, we would buy to close the January 6th 40 strike call and sell to open the January 13th at-the-money call. And of course, that can be done with one order, spread order in your account online that helps you save on commissions and bid-ask spreads. So the energy ETF symbol ERX holds a basket of energy-related stocks and is a 3 times leveraged ETF. So the ERX ETF seeks daily investment results before fees and commissions of 300% of the performance of the Energy Select Sector Index. So ERX is a 3 times leveraged ETF, and if the energy sector is up 1% for the day, then if ERX meets its goal, it'll be up 3% for that day. And if the energy sector is down 1%, then the ERX would decline 3% if it meets its goal. So it's a 3 times leveraged ETF. And because of that leverage, the leveraged ETFs incur more risk the non-leveraged ETFs, but they have very rich option premiums with bigger cash payouts. And we found that when we're trading those weekly covered calls, the bigger cash payouts outweigh that increased risk associated with the leveraged ETF. So we like to trade those leveraged ETFs for weekly covered calls to meet that objective of at least a 1 to 2% weekly cash payout. And criteria number 3 is we want to see the price of the ETF is trending up. The covered call strategy in general is a neutral to slightly bullish strategy. If you remember, we realized the full profit potential for a covered call when the stock closes at or above the strike price of the at-the-money call at expiration. So if you sell the at-the-money call and the stock closes unchanged a week later, then you're going to realize the full profit potential as long as the stock closes at or above the strike price that you sold. So it's not really a bullish strategy. It's slightly bullish. It's neutral to slightly bullish. But we like to only trade stocks and ETFs that are in a price uptrend, and then we avoid stocks that are in a price downtrend when we're entering these covered call trades. So the reason we select stocks in a price uptrend is if you select a price that's in a price downtrend, the downtrend can exceed the cash payout you receive every week for selling that call option. So there's no point in trading stocks that are in a price downtrend when there's plenty that are in a price uptrend, because if they're in a downtrend, the price that the ETF declines could exceed those cash payouts you receive every week. So it's just easier and simple to just focus on the stocks that are in a price uptrend. And we use a simple trend following system to determine that price uptrend. We look at the 1-month price of the stock or ETF in relation to the 10-month simple moving average. And moving averages are a simple method for tracking the price trend. The 10-month simple moving average is calculated by looking at the 1-month price over the last 10 months and dividing by 10, very simple indicator. So the stock or ETF is in a price uptrend if the 1-month price is above the 10-month simple moving average, and the stock or ETF is in a price downtrend if that 1-month price is below the 10-month simple moving average. So we just use a very simple trend indicator. We want to make sure that the stock or ETF is trending up. So here's an example. This depicts the monthly price of the triple Qs right here. This black and red line is the monthly price, and the blue line is the 10-month simple moving average. So we could see back in June, the 1-month price crossed above the 10-month simple moving average. So at that point, the triple Qs were in a price uptrend, and as long as they're in a price uptrend, we can initiate the weekly covered call. So we just like to check the general trend and make sure it's trending up before we enter a weekly covered call. So you can download that 1-month price and the 10-month simple moving average from stockcharts.com or any other of the various financial websites that provide stock charts. And one of the advantages of these weekly covered calls is in a down market, you can trade bearish ETFs. Now, bearish ETFs in a down market, of course, will be trending up. So you'll be selling calls as that bearish ETF is trending up and the underlying basket of stocks is going down. So in bear markets or down markets, you can trade bearish ETFs and profit weekly from the cash payout you receive on the call option that you sell And this is just an example of in the 2008 bear market. This is a snapshot of the SDS. This is a inverse ETF on the S&P 500. The black and red line is the monthly price, and this blue line is a 10-month simple moving average. So when the S&P was going down, this ETF was going up, and you could initiate weekly covered calls with the bearish ETF and symbol SDS. So that's a way to profit in down markets. So you have a lot more profit opportunities when you can also trade bearish ETFs in a down market. So all in all, this weekly cash payout strategy, I think, offers a very attractive returns with low risk. So this is one of the best overall strategies for the average investor. What I'm going to do is just go through quickly. These are, I'm going to show you our brokerage transaction reports that follow, and we added up all the option premium we collected, the cash payouts over the last 10 years. We collected 5.6 million selling option premiums, and the brokerage transaction report, which shows the option that we sold, and this green number here is the amount of cash that went into our brokerage account after commission. So on this first trade, we collected $9,354.61 in cash, and then for this period, we collected a total of $533,000. That was over about a four-month period. And then we've been doing that. So we've been doing this strategy for more than 20 years with monthly covered calls. So this just shows you all the option cash payouts we received and selling option premiums. So I'll just run through these quickly, but over that 10-year period, this came out to $5.6 million, about $47,000 a month. So we're active in trading this strategy. So I think overall this is a good strategy. It's low risk. It doesn't take much time. It's a good strategy, I think, for the average investor. And you can trade this. We trade this with our other strategies, and this is fairly low risk. So it's a good balance with our other strategies and works out pretty well in our portfolio of strategies that we trade. So that concludes my presentation. I'll be glad to take any questions.
All right, Chuck, I know we have had a couple questions pop in during the presentation, and the attendees been nice enough to enter them into the question box there. Didn't know if you wanted to just kind of look through those or.
Yeah, now I'm showing a chat box. I'm not showing a question box.
Just grab a couple here. Have you ever considered using weekly options that expire on Mondays or Wednesdays?
I'm not familiar with weekly options that expire on Mondays or Wednesdays. I know that weekly options we've been trading since they started weekly options have all expired on Friday. So I'm not familiar with those.
Right. And there's another question. What do you do when a covered call and the underlying stock has moved substantially above the strike price at expiration, especially for the stocks that were long before you initiated the covered call?
Yeah, when that happens, if the stock goes up substantially, let's say you sold, let's say it's stock is trading at $50, and you sold the 50 strike call for, let's say, 3 points. So you're going to collect 3 points when you initiate that covered call, and that if it's an at the money, if we sell the at the money 50 strike, that 3 points is all time value. So 1 week later, that time value is going to decay to 0. And if you're short that 3 points and it decays to 0, then the time value portion, which is 3 points in this example, is going to be all profit. So you're going to collect $300 in profits just from the decay of the time value. Now, let's say the stock goes up to 60. So the 50 strike call, you're going to have to buy that back at 10 points to roll over into the following week. So you're going to buy back the 50 strike call at 10, but this underlying stock though has also gone up to 60. So that will match the loss that you incur on buying back the call at 10 points. So by this underlying stock going up, you're going to match that loss on the when you close that option out. But you're always going to collect that $300 of time premium, whether the stock goes up or down. So let's say the stock went from 50, let's say it dropped to 47, you're still going to collect that 3 points of time value because at option expiration, the time value decays to 0. So when you're short that time value, that becomes profit. So it's kind of a hard concept to understand. The way to understand it is every week you're always going to collect the time value portion of that option because it decays to 0 and you're short that option. So you're always going to collect that. And if the stock goes up, then the loss on buying back the call is going to be matched by the underlying stock going up to 10 points. So it's kind of a hard concept to explain until you do it a few times, but basically you're going to still profit every week on the time value portion of that option you sold because it will always decay to 0 the following Friday, and that would become profit if you short the option.
Great. Yeah. So there's a couple more questions too. Is it better to trade this with the ETFs or equity stocks?
Yeah, we do both. We trade equity stocks and we also trade ETFs. So I'd say mostly it's better with ETFs.
Great. And it's in the timing of this, are you covering the weekly option in the morning on Friday or in the evening, or do you sell on Thursday?
Sometimes we'll close it out on Thursday, roll over on Thursday. If if we're going to be busy on Friday, or if we're traveling or whatever. But you can either roll it over on Thursday or roll it over on Friday. As long as you roll it over by the close on Friday, you're good to go for the following week. And as I mentioned, if you're traveling or you're busy and something happens and you can't roll it over and it gets called, well, then you can just, on Monday, you can simply buy 100 shares and sell the weekly at the money call to reestablish the weekly call option. So we roll over on Thursdays and Fridays depending on the situation, and either day I think works fine.
Do you ever let those positions expire?
Normally we don't, unless the stock of the ETF starts trending down, and if it gets into a pretty good downtrend, then we will simply close it out at expiration and look for another opportunity.
Got it. Great. And let's see, another question asking about some of the different products that you have and services. I know that there's a handful of them, and this one's great for someone might want to apply it to an IRA, but if you wanted to kind of give some guidance on some of the stuff that you offer.
Okay, yeah, I would have to put you in touch with our sales partners on that, but we do have two services that do trade the weekly covered calls. Our weekly option alert service does trade weekly covered calls, and we have a pretty good return on those weekly covered calls by rolling those over each week. And on almost all of them, we have reduced the cost basis to zero on the underlying stock because we roll over the profits each week, and eventually you reduce your cost base to zero on those, and then you're playing with the house of money.
Got it. And when you're setting the strike price for, you're going in for the next week, you're ending out that previous week. How are you determining that price?
Yes, we normally will sell to open the at the money call for the following week for the new option. So the at the money call, of course, is the strike price that's closest to where the stock or ETF is currently trading. So if the let's say the stock is trading at 51, and the choices for the following week are the 50 or 55 strike call, then you would sell the 50 strike call because that's closest to where the stock or the ETF is trading.
Got it. Great. We did have another comment in here. Jonathan's a member of your weekly option service, said it's really great and he's done really well with it, and just wanted to send out some thank yous to you as well.
Oh, great. Yeah, thanks for the feedback, Jonathan. I really appreciate it.
Great. And if they wanted to go to a website to get more details, which site would be the best place for them to start?
Well, if you log on to weeklyoptionalert.com, there's information about the strategies that we trade in that option service, and there's also contact information if you're interested in the weekly option alert, which trades weekly covered calls, and you can click the trade results tab at the top of weeklyoptionalert.com, and that'll show you open trade profit results, and which are updated daily, and then also show you each month the trade result for the closeout trades each month. So it's weeklyoptionalert.com, and there's contact information on that too, if you want to contact us about the service.
Got it. Great. We appreciate it. Just kind of scanning through here to see if I can get any more questions. Chuck, appreciate you taking the time today to walk through this. This approach just seems so accessible. You can kind of access it. It's good for traders who are just kind of getting their feet wet into options because it's not super complex. It definitely takes some discipline, and it's simple doesn't mean easy. It is a simple approach, and it seems, from the results that you were sharing, seems to be really effective. So it's a great way to get involved in the options market and really kind of take advantage of the leverage and the power that can be found there. So I appreciate you.
Yeah, and it's not the type of strategy that let's say we go into a bear market very quickly. It's not the type of strategy, if you had these weekly covered calls, you're not going to lose a lot of money like you would if let's say you just own call options and all of a sudden the market takes a dive. If you have leveraged call option trading, you're going to take a huge hit. but with these weekly covered calls, you won't experience big losses. And then each week, even if the market's going down, each week you sell another premium and you bring in more cash. So overall, I think it's a pretty good low risk strategy for the average investor, and doesn't take much time to implement.
Yeah, that's and it's great too to get introduced to this and kind of share this with all the audience too, so that they have that opportunity. And really exciting that we got some folks that have been learning from your education and your different services who've been able to join us and be part of this event as well. So Chuck, thank you so much for your time today and for being a part of the Options Masters Live. I know it was great having you yesterday and last night as well. So thank you so much for putting the time into it. We really appreciate it.
Yes, you're welcome, John, and thank you for organizing. You've done a great job of organizing the conference, and we all really appreciate that.
It's really been my pleasure. Well, folks, thank you guys all for being with us today. We're going to be starting up tomorrow morning. Got a great lineup again tomorrow morning. We go on at 8 o'clock in the morning tomorrow, and our very generous host, Jeff Gibby, is going to walk us through automating some of the stuff that you guys have heard about over the weekend. So we're excited to hear about that, have him explain some of that stuff. So we appreciate everybody's time today, and thanks to all of our presenters. Our presenters have been fantastic. We have such a great lineup. Very grateful and thankful that all these folks have been able to join us and share their experience with us. So everybody have a great night, and we will be right back on in the morning. Take care.